to my channel today. This is King Shooter. It's the first time of joining us. Thank you for clicking to this. Ensure you like, comment, share, and subscribe to our channel. Okay. Now, want to see a video that relates to double taxation. It's the Ican May 2024 exam diet. Okay, exactly the question 3. Now let's see the solution to that. Now the question said, Lagodi Nigeria Limited, a company based in Lagos, Nigeria, commenced operations as a manufacturer of indigenous fabrics / clothing materials in 2013. The finished product are sold to wholesalers and retailers in Nigeria and Africans in diaspora. There's usually a brisk market during annual holiday periods when Nigerians, in particular, come home for visitation and while returning to their foreign destinations, purchase some of these finished fabrics for personal use and or resale purposes. A market survey conducted by Lagodi Nigeria Limited in October 2018 revealed that there was no company in the North American continent that was into the manufacturing of local Nigerian fabrics, hence the opportunity for the company to enter the market. The resolution of the board of the company in one of its meetings in 2019 favored the establishment of a branch of the company in Canada. Kuramo Incorporative, Ottawa, was therefore registered and started operation in January 2022. The company has been operating successfully with gross turnover and profit generated from its operations more than that in Lagos head office in each of the last 3 years. The business operating result of the two companies for the year ended December 31st, 2022 revealed the following. Now we have Lagos, Nigeria, and Ottawa, Canada in thousand. So gross turnover 180 millions. So we have gross turnover 180 million 200,000. So they just indicated the 00 up there. Okay, so I'll just be calling 180,200. For Canada 330,800. Okay, cost of materials we have 17,100 naira. Wages and salaries 18 million 15 naira. Finance costs 1,400,000, miscellaneous 4,600,000, depreciation of plant and equipment 5,760,000, share of head office expenses 25,600,000, foreign tax paid by the Lagos Nigeria dash. Okay, the total expenses is 127,510, and the net profit is 52,690,000. I'm just mixing it up. Okay, why that of the Canada, the gross turnover is 330,800,000. Then the less expenses, the cost of materials 162,320,000, wages and salaries 42,120,000, finance costs 3,150,000, miscellaneous 5,270,000, and depreciation of plant and equipment 8,750,000, and share of head office expenses 60,440,000, foreign tax paid 18,900,000, and total expenses 256,550,000, and the net profit also for the Canada is 74,250,000. Now, additional information: the Ottawa branch is a wholly owned Nigerian company. All the items classified in miscellaneous expenses are allowable for tax purposes. Okay, so it means all the expenses classified in miscellaneous, they are allowable. Okay, so the now said capital allowances as agreed with the Nigerian tax authority comprise Lagos operation 6,800,000, Ottawa operation 9,900,000. Now they said the exchange rate used in the conversion of the Canadian operation transaction to Nigerian currency is fair and appropriate. So there is no exchange rate fluctuation. So they now said V, there is no double taxation agreement between Nigeria and Canada. Okay, there's no double taxation agreement between Nigeria and Canada. So when I say required, in accordance with the provision of Companies Income Tax Act, Cap C21 Law of the Federal Republic of Nigeria 2004 as amended, you are to A, compute the double taxation relief, if any, available to the Nigerian company. B, advise on the tax liabilities of the Nigerian company for the relevant assessment year. C. Comment on the implication of double taxation agreement on withholding tax deduction by a company resident in the country. 1. With no double taxation agreement with Nigeria. II. With double taxation treaty with Nigeria. Okay. Let's solve this question. Okay. Now, remember we have done videos on double taxation. We are going to still take it from scratch. The introduction part. We're just solving some question as um, some subscribers keep sending some question. I solve for them, but we're going to still take it from scratch. Okay, so let's if you have not seen the two video, please check in the playlist double taxation. You are going to see the previous videos we've done on that. So let's see this question now. If you notice here, now they said some several story. That's one thing about Ican question, or you have to ensure your eye is fixated on what you want to solve. Okay, so we're going to start with the name of the owner, which is Lagode Nigeria Limited. Okay, so we start with uh, the net profit. Net profit, remember, we're going to have for Lagos, Nigeria. Okay, then we also have for Ottawa, Canada. Canada. Okay, then the total. So all this is in this. Okay, so we'll have the net profit. So from the question there, the net profit for the Nigerian is 52,690, right? Why for the Canada is 74,250. Okay, so if you add them together, 52,690 plus 74,250 with our calculator, it will give us 126,940. 126,940. So we're going to add back non-allowable expenses. Okay, and one of it there is depreciation. Okay, so we're going to add back depreciation. So if you check there, the depreciation for the Nigeria is 5760. Okay, and that of the Ottawa is 8750. So if you add them together, this plus this, it will give us 14,510. Okay, so another thing we're going to add back is the foreign tax paid. If you check the question there, some of the expenses that was deducted for the foreign tax is the foreign tax paid. So we have, yeah, the foreign tax paid. So for Nigeria it's dash, but it was paid for Canada 18,9. So it means here will give us 18,9. Okay, so now let's check if there are other non-allowable expenses we're going to add back. Wage and salary, no. Finance cost, no. Miscellaneous, they already said it is allowable. All the expenses that are allowable. Depreciation, we have done that. Share of head office expenses. Okay, there is no other one. So now let's get the total. So 52,690 plus 5760 will give us 58,450. Why 74,250 plus this will give us 101,900. So if you add these two together, we'll have here 163,350. Okay, so we're going to less our capital allowance. Less the capital allowance. So the capital allowance here, like I said, for the Lagos operation, it is 6,800. Okay, and for the Canada is 9,900. So this plus this will give us a total of 16,700. Okay, so if we less that, so this minus this will give us 51,650. This minus this will give us 92. So if I add these two together, we'll have 143,650. Okay, 143,650. So 143,650 is our profit. So now let's get the income tax payable. So we now have the income tax payable that is supposed to be paid. So we have 30% of 143,650. So we have 143,650. So this times this will give us 43,095. Okay. So from this now, 43,095. Now from this now, they are supposed to get a relief. So we're gonna get, let's say, less double taxation relief. Okay. Now let's compute the double taxation relief. So now to compute the double taxation relief, now we have always done that. So we'll say the adjustment. Now the first one, we know that the the Nigerian tax rate is 30%. So the half Nigerian rate is 15%. Okay. Now let's now get the Commonwealth rate. Now how do you get the Commonwealth rate? It is the foreign tax paid divided by the foreign profit times 100 over 1. So what's the foreign tax paid? Foreign tax paid is 18,900 divided by the foreign profit is 92 times 100 over 1. Okay, so let's now get the, so with our calculator, it will give us 20.54%. 20.54%. Okay, 20.54%. Now we have a note 20.54%. So say, but it said if the Commonwealth rate is greater than the half Nigerian rate, then our relief will be the half Nigerian rate. Okay? Now say this is the Commonwealth rate, which is 20.54%. It is greater than half Nigerian rate is 15%. So our relief will now be 15%. So use 15% on 92,000, which is foreign profit. So it will give us 13,800. 13,800. Okay. So our relief here, I say check in notes. This is note 1. That's A and B. Check in note 1. So our relief is 13,800. So instead of them paying this, they're deducting this. So 43,095 minus 13,8 will give us 29,295. 29,295. So that becomes a tax liability. Okay, that becomes the tax liability. So we have answered the A and B. Say compute the double taxation relief available. This is the double taxation relief. We've computed it, and they said the tax liability. That is the tax liability. Okay. Now they now say C. Comment on the implication of double taxation agreement on withholding tax deduction by a company resident in a country, by a company resident in a country with no double taxation agreement with Nigeria, with double taxation agreement in Nigeria. Okay, so we said if a company is resident in a country and it has no double taxation agreement in Nigeria, okay, there will be a deduction on its withholding tax at a deduction rate of 10% of its revenue that arise from the interest, royalties, and dividend. Okay, so 10% if they have no double taxation agreement, okay, on its withholding tax. So that is when they don't have. Why the second one, second question said, I with double taxation treaty with Nigeria. So what will happen if they have a double taxation treaty with Nigeria? The same thing, they will suffer a withholding tax deduction on 7.5%. So the first one, no double taxation agreement, 10%, while the second one, they have double taxation agreement, 7.5%. Okay, so that's the question. So that's the ICANN 2024. Thank you very much. And sure you like, comment, share, subscribe to our channel. Follow us on our platform. Thank you very much.